Have you ever bought a stock high, panicked, and sold it low, only to watch it shoot back up? If so, you're not alone. It's not because you're bad at investing. It's because your brain is hardwired to make some classic mistakes. Today, we re-dive into the fascinating world of behavioral finance to uncover why your brain sabotages your investment decisions and, more importantly, how you can stop it. We'll explore some powerful ideas from pioneers in this field, like Daniel Kahneman and Amos Tversky, who showed us that we're not as rational as we think, especially when it comes to money. So, let's get into the first big mistake our brains make: herd mentality. You see a stock everyone's talking about, your friends are buying it, it's all over the news. You feel a massive fear of missing out, or FOMO, so you jump in. This is herd behavior in action. We're social creatures, and we assume that if everyone else is doing something, it must be the right thing to do. Think about the dot-com bubble in the late 90 segundos. People were pouring money into any company with a .com in its name, not because they understood the business, but because everyone else was. When that bubble burst, a lot of people lost everything. The lesson here is that the crowd isn't always wise. Following the herd can lead you right off a cliff. The second mental trap is called loss aversion. Psychologically, the pain of losing $100 feels way worse than the pleasure of gaining $100. Studies show it can be twice as powerful. How does this mess up your investing? It makes you hold on to losing stocks for way too long. You think, I'll just wait for it to get back to what I paid, and then I'll sell. You're avoiding the pain of realizing a loss, but this can be a disaster. A bad investment can just keep getting worse. On the flip side, loss aversion can also make you sell your winning stocks too early. As soon as you have a decent profit, you get nervous about losing it, so you sell, potentially missing out on much bigger gains. You're locking in a small win to avoid the potential pain of it turning into a loss. And the third big one is overconfidence. A lot of us think we're better than average drivers, and it's the same with investing. We think we can pick the winning stocks, time the market perfectly, and beat the pros. This overconfidence leads to frequent trading. We're constantly buying and selling, trying to chase the next big thing. The problem is, every time you trade, you incur cost brokerage fees, taxes that eat away at your returns. Research has consistently shown that investors who trade the most often tend to have the worst performance. You think you're being a savvy, active investor, but in reality, you might just be churning your own account and making your broker rich. You overestimate your skill and underestimate the role of luck. Let's look at a real-world story that ties all this together. Think about the rise of GameStop in early 2021. It started as a smart, contrarian bet by a few investors who saw the stock was heavily shorted. But then, it went viral on social media. Suddenly, herd mentality kicked in. Millions of retail investors piled in, driven by FOMO and a desire to be part of a movement. The stock price went to the moon. People who bought early and sold near the top made a fortune. But what about the people who got in late? They were driven by the herd. Then, when the stock started to fall, loss aversion took hold. Many held on, hoping it would go back up, refusing to accept the loss. They saw their accounts drop by 80 or 90%, and overconfidence was everywhere. People who'd never invested before thought they had found a magic formula to beat Wall Street. This one single event is a perfect storm of the cognitive biases we've been talking about. It shows how powerful and dangerous they can be when they all work together. So, how do you fight back against your own brain? What are the actionable steps? First, and most importantly, have a plan. Before you invest a single dollar, write down your goals, your time horizon, and your strategy. For example, I will invest in a diversified portfolio of low-cost index funds and hold them for at least 10 years. I will rebalance once a year. This written plan is your anchor. When you feel the pull of FOMO or the panic of a market drop, you go back to your plan. It keeps your emotions in check. Second, automate your investing. Set up automatic transfers from your bank account to your investment account every month. This is called dollar cost averaging. You invest the same amount of money at regular intervals, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more. This takes the emotion and guesswork out of the equation. You're not trying to time the market. You're just consistently investing for the long term. It's the simplest way to overcome the urge to trade too often based on overconfidence or fear. My third tip is to limit how often you check your portfolio. If you're a long-term investor, looking at your account balance every day is a recipe for anxiety. Market fluctuations are normal, but seeing those red numbers can trigger loss aversion and cause you to make rash decisions. Maybe you check once a month, or even once a quarter. By creating some distance, you give your strategy time to work, and you protect yourself from your own emotional reactions. Remember, investing should be like watching paint dry. If you want excitement, go to a casino. So, to recap, our brains are not naturally built for successful investing. We fall victim to herd mentality, aversion, and overconfidence. But by understanding these biases, we can start to fight back. The key is to stop making emotional decisions and start making systematic ones. Create a solid investment plan, automate your contributions so you're consistent, and stop obsessing over daily market moves. It's about building good habits that protect you from your worst enemy, yourself. Thank you so much for watching. I hope this look into behavioral finance helps you become a smarter, more successful investor. If you found this helpful, please hit that like button and subscribe for more content on making better financial decisions. Let me know in the comments which of these biases you've struggled with the most. See you in the next video.